Cryptocurrencies such as Bitcoin, Ethereum, and many others have revolutionized the world of finance and economics. However, many people still have doubts about how cryptocurrencies work in fiscal terms. This article aims to clarify these doubts, covering both the basic principles and the more advanced aspects of this subject. First of all, it is important to understand what cryptocurrencies are. Cryptocurrencies are digital currencies that use cryptography to ensure secure transactions and to control the creation of new units. Unlike traditional currencies such as the dollar or the euro, cryptocurrencies are not issued by a central bank or government, but are generated through a process called mining, which involves solving complex mathematical problems. When it comes to taxation, cryptocurrencies are generally treated as property for tax purposes in many countries, including the United States. This means that when you sell, exchange, or otherwise dispose of a cryptocurrency, you may have a capital gain or loss that must be reported on your income tax return. The gain or loss is the difference between your base cost, the amount you paid for the cryptocurrency, including commissions and other expenses, and the amount you received when you sold it. If you hold the cryptocurrency for more than a year before disposing of it, any gain or loss is treated as long-term. If you hold cryptocurrency for a year or less, any gain or loss is short-term. Long-term capital gains are generally taxed at a lower rate than short-term capital gains. In addition, if you receive cryptocurrencies for goods or services rendered, you must include the fair market value of cryptocurrencies in your gross income. Fair market value is the dollar amount you would receive if you sold the cryptocurrency in the open market on the day you received it. It is important to note that cryptocurrency mining also has tax implications. If you mine cryptocurrencies, you must include in your gross income the fair market value of cryptocurrencies on the date you receive them. Additionally, if cryptocurrency mining is your thing, you may be able to deduct your mining-related expenses such as the cost of electricity and equipment. Finally, it's important to remember that tax laws can vary from country to country. Therefore, it's always a good idea to consult a tax professional if you have any questions about the tax implications of buying, selling, trading, mining, or using cryptocurrencies. In conclusion, cryptocurrencies are an exciting new form of currency that have the potential to change the way we transact. However, like any other type of property, they have tax implications that must be considered. If you're considering investing in cryptocurrencies, it's important to understand how they work, not just in terms of technology, but also in fiscal terms. Thanks for watching today's lesson. Crypto is transforming our lives, and we're here to help you understand why it matters. At Crypto Edge Learning, you get top-tier education for free content that's paid elsewhere, right at your fingertips. If you love this, hit that like button, subscribe, and tap the bell icon so you don't miss out. Stay excited, the next lesson's coming soon with even more insights. See you there.